Hi, Jimmy. How are you today?
I'm doing great, Jeremy. How are you?
Pretty good, man. All right. Well, we're doing our market insights for Q2 of 2023. So let's get after it.
Sounds like a plan.
So the portfolio points that we want to mention for our clients are threefold. We've got sort of these themes playing out within the quarter. International was a performer, and we were predicting that based on some of the dollar valuation pieces, right?
Yep.
We have a return to tech. This was an unexpected thing, and we're going to talk about this and how the NASDAQ really outperformed.
Yep.
And then lastly, fixed income.
So
Lots going on there.
lots going on there. Been a hot topic.
No doubt. So Jimmy, we put this up on the slide today because we want to just highlight that, as always, your allocations are really the biggest thing, right?
Absolutely. Yeah, again, when you think about track as an acronym, the R, is the risk adjusted, right? And so it's important to note, what was your return relative to the amount of risk that you were taking in the portfolio. I think oftentimes, when we've met with prospects, the risk profile that they think is appropriate for them might not actually be reflected in their portfolio. So it's really important when you're talking about that allocation piece being important, understanding the risk in that allocation.
So there's some typical kind of portfolio allocations here: 60-40, 70-30, 80-20, 90-10. There's all sorts of gradations between these as well.
Absolutely.
But this is an important fact that we always bring back to our touchstone. You have to think about allocations. And the asset class returns. So this is a slide that we were looking at last quarter. These are not going to change a lot quarter over quarter, but within year to year, you're going to see some differences.
Absolutely. So this ties in exactly what we were just talking about, the allocation and risk, right? So your far right column there measures the volatility of each asset class and then the subsequent returns. So when you follow the white box there for the 60-40 portfolio, you'll notice that over that this long time period, it's the fourth best return, yet it has the one of the least amount of volatility. So when you start assessing your return adjusted for risk, the 60-40 portfolio, given a long period of time, has proven to be quite the allocation.
Right. And that's not to say that the 60-40 is for everybody. Obviously,
Sure, right.
We know this, right? We just want to reiterate that these are going to be customized to one's own particular case. How close they are to retirement, how far away they are from retirement, what their needs are. So many different factors that go into that financial planning process.
Absolutely.
So from a macro standpoint, we've got some things that are definitely changing, and this slide does a good job of pointing that out. We all know that inflation has been the hot topic for more than a year now.
Right.
And this is the CPI showing where we were hitting the top of the cycle, and that was back in June of 22. Mm-hmm. It was 9.1%. That sounds almost unrealistic, but it certainly was the reality.
Well, you think the Federal Reserve really cut interest rates following the great financial crisis that we went through in 2008, and so the Federal Reserve has cut rates to help stimulate economic activity, and the hope was for so long they have been trying to stimulate and bring inflation into the fold, and it just maybe it took a global pandemic to really spur it along, but you do see a reversal or a slowing down. Unfortunately, the inflation hasn't slowed at the same pace that it showed its face last year, but nonetheless, you do see a better looking trend here on the inflation numbers.
No doubt about it. So in March, the simple math here, we're down over 4 points.
Right.
We're down to 5%, which is a much more reasonable inflation rate. The Fed still wants to see us go back to that 2% long-term rate. We're quite a bit of ways off of that, but inflation seemingly is becoming a story maybe of the past and not so much of the future.
Absolutely. Now, again, that could change at a moment's notice, but for the time being, we're seeing positive trends in the decline of inflation.
And this has tons of implications. We don't want to get into all the macroeconomics of it all, but obviously there's, on the fixed income side, we're seeing a lot of opportunities that weren't there before.
Yep.
On the equity side, it has been a little bit of a slowdown for us for sure. We saw that in 2022. That story is changing here in 2023.
No question. I mean, equities have proven, it's objective fact for equities to have been the best hedge against inflation over long periods of time. So it's certainly an important part of the story.
Well said. Another slide that we've been looking at, and we think continues to be like one of these fundamental pieces that you need to look at. It's S&P 500, top 500 domestic equities in the marketplace, and you have this 25-year average that kind of cuts right through the middle. That's at 17.81 PE and price to earnings forward ratio. And so, tell me a little bit about what you're seeing here. Is there any real fundamental differences quarter over quarter?
So the short answer is no. In the first quarter, we didn't see any massive shift here. But I think an important thing to think about, again, when we're coming back to allocation and risk and volatility, valuation is always a great place to start, sort of like a top-down review of your allocation, and just trying to figure out at what price am I buying into the market at this point, right? And so essentially, when you look at this, right now the S&P 500 is very close to being in line with its 25-year long-term average.
Yes, and so you saw that run up in valuations in 2020 and 2021, and certainly that was driven by a variety of different factors. But one of those factors was that there was no place else to go with dollars, right? The international markets were relatively weak. The fixed income markets were relatively weak as well. We all know that.
There was no interest rate, so
there was nothing to have, nothing to grab onto.
Which is what they were trying to do, though, right? I mean, that's when you keep rates so low, you're trying to stimulate economic activity. You're trying to bring on inflation. And one of the things that's going to happen is asset prices are going to inflate when you can't get anything from a fixed rate of return on a bond. Well, all of a sudden the equities look much cheaper. So even though they were possibly expensive relative to their own long-term average, they still, for a long period of time, are looking relatively cheap compared to their fixed income counterparts.
Yeah, that's a great point. That's a great point. Now that we're back towards the reversion to the mean,
yeah,
right? Certainly you can say to yourself, if you're a buyer, right? Now it is still significantly cheaper to get into the marketplace today than it was
right.
A couple of years ago, or even just a year ago,
yep.
right? So we're seeing a little bit of difference quarter over quarter, but it's nothing substantial.
Right.
It all speaks to the fact that we actually had a good Q1 overall for the market
right.
in 2023 here. So once again, these are those PE ratios and equity returns over a 1-year period on the slide, or the chart to the left, and then the chart to the right is over a 5-year period. And explain to everyone what we're looking at here, Jim.
So this is again coming back to volatility, the markets, understanding your allocation. Valuation is a very important metric to follow. That's why we started with that slide and looking and assessing the U.S. market. The key to this is understanding that in the next 12 months, it's pretty much impossible, is what the chart on the left shows you, to predict what the stock market is going to do for the next 12 months. It's just too short of a time period. However, when you get a little bit longer term, assessment of where our starting point to where we would expect the market returns to be, you see that chart on the right really starting to cluster around and a much more concentrated position of the dots for what the future returns look like. So again, this is just getting back to the importance of, when you think about a financial plan, understanding your allocation, volatility, valuation, all these things we've been talking about. It's important to know that we're looking at this with a longer term horizon.
And that's where that R squared number is. It's a 5% on the shotgun blast to the left. It's 34%, meaning it's tightening up.
Absolutely.
The correlation's there. And so, yes, at every point that you made, I'm not going to reiterate. I think you did a fantastic job. So this all kind of speaks to the value versus growth dynamic.
Mm-hmm.
You have growth stocks, you have value-oriented stocks, and talk to us a little bit about what you're seeing in this chart.
So again, it's looking under the hood of understanding how are you invested, what companies are you actually invested in, whether that be through mutual fund, ETF, or if you're actually owning individual stocks. How are you actually allocated? And in understanding the difference when you look under the hood of U.S. stocks, there are stocks that are broken down to being considered value-oriented stocks. Typically, older companies, more mature companies that have been around for a long period of time tend to pay a higher dividend.
Right.
Not a ton of reinvestment in of their profits. More returning the profits to the shareholders. Whereas the growth stocks are more of your tech stocks, where there is a lot of reinvestment back into research and development, trying to maybe acquire competitors, cutting edge technology, things like that. And so what we have seen in the last decade plus with that basically zero interest rate environment that we've been operating in is that the growth stocks had outperformed value for quite some time. And that all made sense. However, as we saw inflation rear its head in 22 in a meaningful way, the value stocks tend to start doing better in those environments. And because of the tech outperformance of the last decade, we've seen value stocks look cheap relative to their growth counterparts. And we saw just more of that expanding here in the first quarter of 23. You still see value is, we talked about this in the end of last year, is still cheap relative to the growth counterpart.
It is, and which is to say that value is always probably a pretty good opportunity for people.
Sure.
Right? That it's not an in vogue subject necessarily, right? It can become one, but people have an opportunity now to participate in value buying,
Right.
and do really going for a long-term investor. It is a great opportunity.
Absolutely.
Plus those dividends, folks. Jimmy pointed that out. It is very real. There's a good spread here between the long-term average that you have on those value stocks versus the growth stocks. 2.5% more. It's 2.59 versus 1.34. That's a big spread.
That's a big
right?
spread.
Those are meaningful numbers over a long period of time when you're talking about dollars and cents.
Especially when when you are looking at times of inflation where the interest rates are moving up, which is typically a headwind for the growth companies. It's nice to have that income stream coming in as a little bit of a ballast to the return.
All right, we're switching gears. This is one of the charts that we've created here at On Track, and we're looking at the U.S. dollar, and then its 200-day moving average and its 50-day moving average. And the trend that we looked at a quarter ago is now firmly in place. It is playing out, right? So talk to us about that, Jimmy.
Yeah, so this has a material impact and influence on international equities. And so what we saw and what we're tracking here on an ongoing basis is, from a macro perspective, how does the dollar compare to other currencies out there? And what we saw is, last year we saw a clear breakdown in the dollar, where it had dropped below the 50-day, and then when it dropped below the 200-day, and it maintained below that 200-day moving average for a while. We saw in the fourth quarter last year, all of a sudden the international stocks started performing better than their U.S. counterparts. And in the first quarter, we've seen it, that trend continue. Now you'll see, sometime in middle March there, we did sort of like retest the 50-day moving average, that blue line, but then the dollars rolled back over subsequently. And as we stand, as we're filming this, you've got that dollar staying well below the 200-day moving average from the end of 22 through the first quarter of 23. We've stayed well below the 200-day moving average.
So this all ties into our very next slide here that shows how international has performed as a result, in part, due to the dollar.
Sure.
So now we're tracking 5 different indices. The one on the top is the international developed.
Yep.
And then we have emerging markets international.
Yep.
Followed by the S&P, the Dow, and the NASDAQ. Okay, so you're seeing a clear clustering of 4 of them, and then great outperformance by one of them.
Yeah. So now this is a meaningful period of time. When we first went through this exercise at the end of 22, we had just started to, follow this trend, and we weren't sure how long does it need to be a trend. But you're now covering 6 months of data here, and the thing that jumps out at you without question is the purple outperformance of the developed international markets, and that's a substantial amount of outperformance over now what I would say is a meaningful period of time.
It really is, and if we were to compare this to what we saw last quarter, we were starting to see the beginning trend here,
Right.
And international and the developed, developed and emerging were much closer together.
Right.
Now you see that gravity is bringing the emerging markets down a little bit, but it's still, even despite that, it's still outperforming its domestic counterparts.
Again, yeah, and again, over a relatively speaking meaningful period of time.
Yeah. So this is a very interesting tilt that we could really see people embracing in their portfolios, is moving a little bit of their funds out of, say, the domestic spend into international.
Absolutely.
And in a big picture, much broader cycle here, when you're talking about, we're talking about 50 years worth of trends here. What you see is that in the purple, that's when international is outperforming, the international equities are outperforming the domestic ones, and it clearly goes in different trend cycles.
Right, absolutely. So you can see, obviously, we're on the back end possibly of a very long outperformance from the U.S. stock market.
Right.
And prior to that, though, and this is sort of where you're wondering, do the trends that we're seeing now match up with some of the trends that we would have seen in the prior years of the purple international equity outperformance? It appears that way. That's it's impossible to tell what the future is going to hold and if these trends will continue. But as the last chart that we built just showed, you have had some outperformance over the last 6 months in the international space.
All right, we're going to go over to the fixed income side now.
Yep.
And this is also a chart that we've looked at before. We're seeing that the inversion is still very much so a thing.
Yep.
The blue line here is the most recent data point placed in there. I don't know that there's a whole lot to say here other than there's been a lot of volatility in the bond markets, and we're still seeing this inversion, which is indicative of maybe some recessionary environment that we're plowing into,
right?
Whether we want to or not.
Well, again, I mean, it's obviously because it just signals that things are not normal right now, because it doesn't make any logical sense that you should be getting paid more interest on a 3-month investment than you would be getting on a 30-year investment.
Right.
So that inversion has been steep. It has been prolonged, and it will be interesting to see how the amount of time it takes for us to get a more normal sloping yield curve, as you see it indicated where we were at the end of 2021, and that black line down there. It's a much more normal sloping yield curve.
So one of the things I want to bring up is, you're going to see now things like banks and credit unions responding to this. And they're all of a sudden now going to be starting offering much better money market rates for you to deposit your money in that institution, right?
Right.
The question is going to be is how long is that going to last? It is very uncertain, right? And this is the point at which you start saying to yourself, when do we want to spread that out a little bit for a little bit longer duration on this yield curve? And what does that look like? We believe that one of the best things you can do is build ladders.
Sure.
And so you're not just committing to a 3-month, you're not just committing to a money market that's going to move up and down with the whims of the marketplace.
Right.
But rather, you're being a little bit more strategic about it, and you're building out with purpose.
It's like diversifying with equities. I think most people understand the importance of diversification in their portfolio, but this is, what you're talking about with the ladder there is diversifying your fixed income risk.
Yes.
And particularly at this point, we're talking about really is the reinvestment risk.
That's right.
Of the short term. How long are the short term rates going to stay superior to the longer and intermediate term? At some point in time, you're not going to be able to get 5% on a 3-month treasury.
That's right. It's going to perhaps disappear, and
Right.
then you're going to be like, oh shoot, maybe I should have gone a little bit further out, but I was
Correct.
seeking that little bit percentage better here in the
That's
short term,
exactly
right? So
right.
you have to play a balancing game here on this, and I think the laddered approach really helps to do that.
No question.
All right, let's sum it up. Q1 was good.
Right?
I mean, you just can't deny it, right? I mean, 2021 or 2022 rather had such a negative connotation to it
For sure.
in all respects. But let's talk about the good points here. The Nasdaq was up 17%.
Again, you talk about the return to tech, right? So what looked broken in 2022 is back in a meaningful way to start the first quarter of 2023.
It was. The S&P had a nice quarter as well at 7.5%. The Dow was underperforming compared to where it had been comparative relative to its other domestic peers, right?
Right, exactly. Now we don't have a chart for this, but we did look and see if you were to go back 12 months from 12 months ago from where we're at today, the Dow still is the best performing and still is outperforming the Nasdaq. However, the Nasdaq, that's because the Nasdaq had a precipitous decline in 2022, but has also had a roaring start to 2023.
And then the international, we were talking in detail about this. IFA is the developed market that is up 8.6%.
Right.
Very, very nice. That's just the quarterly number.
Yep.
As we know, that trend started a little bit earlier. And then emerging was up 4%. So we still feel as though international is a nice tilt, as we've been saying thematically, and someplace to grab a little bit more return.
Absolutely. Well said.
Fixed income, boy, oh boy, this was a crazy quarter. There was rate hikes, the debate about whether we were going to stop rate hikes, the miniature bank crisis with Silicon Valley Bank, the economy as a big kind of rain cloud overhead. There's a lot going on in the fixed market.
Yeah, it was a wild time for sure. The Silicon Valley Bank will for sure be a case study for many master's classes ahead in future years. A lot of interesting dynamics involved there, but like you said, it's brought on a lot of volatility, and maybe now we are getting to that point though where there really is that opportunity for the total return. To the point you were bringing up before, maybe now is the time that you do need to start diversifying your fixed income bets along the yield curve.
So what you're saying there is you're saying if you go out a little bit further on that curve and then rate hikes stop and instead we start to drop rates again to re-energize the market, well, then there's opportunity to make capital gains on your fixed income.
Absolutely right.
So that's an interesting piece, and that all goes back to wrapping it up with where we always start, the asset allocation.
It sounds boring and cliche, but it is oh so true. And again, I think what we really want to get across to people here, understand how you're invested, right? Understand, is that the proper risk profile for you, right? And really take the time to get underneath the hood and figure out how you're invested. The allocation is the most important piece.
Well, thanks for doing another quarterly update here.
Love it.
Really appreciate it. Folks, we'll see you next quarter. Thank you very much. If you need to get a hold of us, here's our number and an email that you can reach us at, hello@OnTrackPlans. Thanks again for joining us.